Active trading versus long-term investing. Which strategy yields more profits? Have you ever felt stuck trying to determine whether to engage in active stock trading or make long-term investments? I understand. With active trading, the appeal of enormous wins appears impossible to resist. However, the data is accurate. Long-term investing generates greater returns. I am aware that when opportunities are flashing before your eyes, it seems nearly difficult to control those impulsive trades. But take into account that going after those quick profits frequently results in purchasing high and selling low. Your account quickly depletes as you desperately try to time the market. Long-term investors, meanwhile, allow their money to grow over many years. Their wealth grows as a result of investing dividends from holding reputable corporations. You'll be grateful you had the self-control to proceed slowly and steadily in the future. Remember that perseverance always wins the race the next time you find yourself tempted by active trading. Avoid the impulse to constantly monitor your portfolio. Have a long-term perspective. Watch your returns grow over time as well. The key distinctions between active trading and long-term investment methods are summarized below. Engaged trading concentrates on rapid price changes to produce profits. By repeatedly buying and selling, traders hope to profit from volatility. Typically, positions are kept for days or weeks rather than years. Necessitates ongoing market observation. A riskier and more speculative approach. Investing for the future. Puts emphasis on keeping assets for a long time. Long-term growth trends are what investors hope to profit from. Jobs held for decades or years, not days or weeks. Buy and hold investing requires fewer trades per year. A more cautious strategy centered on compound growth. The key distinction is that whereas long-term investment adopts a more passive strategy to allow gains to accrue over many years, active trading relies on timing the markets to profit from short-term movements. Each tactic necessitates a distinct attitude and level of risk tolerance. The following are some of the main advantages and disadvantages of active trading in comparison to long-term investing. Positive trading activities. Possibility of generating substantial returns quickly. Can profit from market fluctuations and turbulence. Exciting compared to passive investment. The trader has more power over entry and exit points. Downsides of active trading. Demands ongoing market monitoring and study. Lower earnings due to increased trading and tax charges. There is a considerable danger of losing money when trading. It's challenging to regularly predict market movements. Benefits of long-term investing. Gains over time via compound growth. Lower taxes and trade expenses. Requiring less time and effort to manage investments. Does not require market or trade timing. Cons of long-term investing. The returns grew gradually over several years. Failing to profit from price fluctuations that occur more frequently. Portfolio losses occur during extended bad markets. Demands patience and self-control. Goals, time horizon, and risk tolerance of an investor all affect the best course of action. Long-term investing is more conservative but steady, whereas active trading has greater potential returns but also greater risk. Several significant historical data points and statistics show that long-term investing outperforms active trading over time, including the following. Since its establishment in 1926, the S&P 500 has generated an average return of 10% each year, despite multiple crashes, bear markets, and recessions over the years. According to a Dalbar analysis, due to poor market timing, the average equity mutual fund investor only made 2.9% over the 20 years ending December 31, 2020, while the S&P 500 returned an annualized 9.9%. Over periods of 10 years or more, passive index funds outperform the bulk of actively managed funds. For instance, 85% of active large-cap fund managers underperformed the S&P 500 index over the past 15 years. From 1950 to 2009, the buy-and-hold investment strategy in the S&P 500 had an overall return of 7,433% as opposed to merely 16% for market timing tactics. J.P. Morgan Asset Management conducted an investigation on two fictitious investors who held equities for 20 years. The long-term investor never sold, while the active trader tried to time market declines. Annualized return for the long-term investor was 8.2% versus 2.6% for the active trader. According to Dalbar, due to bad short-term trading decisions, the average equity mutual fund investor only made 3.98% during the 30 years ending in 2020, whereas the S&P 500 returned an annualized 10.35%. The lesson here is that, for most investors, patient, long-term investing is more profitable than attempting to time the market through active trading. In comparison to long-term investing, taxes, fees, and compounding returns significantly affect the potential profitability of active trading. Here is an explanation. Taxes. Since short-term capital gains tax rates are greater than long-term capital gains tax rates, active traders will pay more in taxes. It is more difficult to qualify for a lower long-term gains tax rate when you trade often. Transaction costs are substantially greater for active traders due to commissions and bid/ask spreads, which reduce returns. Transaction costs are low since long-term investors don't make many trades. Compounding. As reinvested profits grow on prior gains year after year, compounding offers significant advantages to long-term investors. Active traders experience gains and losses more quickly, losing out on compounding. An illustration would be what a $100,000 investment with a 10% annual return over 20 years would be worth. After 3% taxes on short-term gains and 1% fees, active trader, $484,000. After 0.2% in fees and 2% long-term capital gains taxes, long-term investor, $673,000. In comparison to the portfolio of an active trader, the long-term investor earns 39% more money thanks to compounding and fewer taxes and fees. This illustrates how those crucial elements reduce the earnings from active trading while increasing long-term gains. When compared to long-term investing, active trading is more compatible with the following personality qualities and levels of risk tolerance. Trait active personalities. Love adventure and risk-taking. Quick thinkers who put their instincts first. Extremely high risk-taking. Take pleasure in observing rapid price changes. Being competitive and attempting to beat the market. Characteristics of long-term investors. Remaining calm and collected despite market fluctuations. Not prone to react out of panic or emotion. Low tolerance for risk. Content with generating mediocre market returns. Make long-term investments. Active investors are typically highly competent, thrill-seeking individuals who don't mind volatility, frequent trading, or taking calculated risks in order to make quick money. The risk-averse mindsets of long-term investors are typically more concerned with consistent portfolio growth than with pursuing big gains immediately. Their top priority is steadily accumulating wealth during their lifespan. The ideal plan complements an investor's character traits. While long-term investing is best for people with patience and discipline, active trading is best for those with a risk appetite. Here are some examples from the actual world that demonstrate the long-term profit difference. By making long-term investments in businesses, Warren Buffett's Berkshire Hathaway has produced an average yearly return of 20% since 1965. In contrast, the S&P 500 returned 11% during the same time period. Renowned short-term trader Jesse Livermore passed away insolvent, whereas Bernard Baruch, a long-term investor, left behind an estate that is now valued at over $100 million. Thanks to long-term compound growth, a dollar invested in Coca-Cola stock in 1962 would be worth almost $2,000 today. These returns probably would not have been achieved by day trading Coca-Cola shares. John Bogle, the creator of Vanguard, outperformed the majority of active traders by generating returns of over 10% per year for decades by simply placing client money in index funds. While managing the Magellan Fund from 1977 to 1990, Peter Lynch generated an annual return of 29% on average. The majority of active traders, however, underperformed the market. In contrast to modern traders who tried to time the Great Depression, John Maynard Keynes made over 12% every year from 1921 through 1946 using a protracted buy and hold strategy. The lesson is that eminent long-term investors like Bogle and Buffett show how long-term compounding outperforms most short-term speculative trading over a period of decades. Patience pays off. The following are some typical trading tactics and strategies employed by active traders in an effort to make quick gains. Day trading entails purchasing and selling assets during the same trading day in an effort to profit from swift price changes. Requires constant, detailed monitoring of the markets. Swing trading attempts to profit on days or weeks-long medium-term price swings. Using technical analysis to identify trends and predict entry/exit points may be necessary. Scalping, a very short-term approach that focuses on generating small but regular profits from slight price swings. Relies on making fast trades in and out. Leveraging margin, leveraging borrowed funds from the broker to boost purchasing power and potential trade earnings. Significant risk is added. Short selling, attempting to profit from falling stock prices by borrowing money, selling shares at a premium, and then buying them back later at a discount. Algorithmic/high frequency trading. This type of trading makes a lot of quick, short-term trades in an effort to take advantage of transient inefficiencies. News/event trading, an attempt to profit on price increases resulting from corporate events, economic data, earnings releases, clinical studies, etc. Technical analysis, the process of identifying trading opportunities and determining the best time to enter and exit a trade by using chart patterns, indicators, and other technical tools. Active trading entails significant risks, but speculative traders may find the potential gains to be too alluring to pass up. For these tactics to be successfully implemented, patience and self-control are needed. Here are some typical long-term investment plans that emphasize moderate, consistent growth. Buy and hold. In this strategy, stocks or funds are purchased and held for a long period of time while compounding does its magic. Requires endurance and the commitment to remain with investments through tough times. Dollar cost averaging, investing the same amount of money on a regular basis, like $500 each month. This reduces volatility and removes emotion from the investing process. Dividend reinvestment is the automated process of converting dividend payments into more shares of business stock. Compounding is turbocharged by this. Value investing, searching for shares of strong businesses that the market believes are inexpensive given their fundamentals. Emphasis is placed on long-term business value. Investing in market index funds, owning these funds will provide you with a wide range of diversification and average stock market returns over time. A non-active strategy. Quality over quantity, holding a select group of businesses with distinct competitive advantages and predictable financial results as opposed to a diverse assortment. Retirement investing is the practice of investing as much as possible in tax-advantaged retirement plans like 401ks and IRAs and letting the money grow tax-deferred. The fundamental ideas include compound returns, patience, discipline, expense reduction, and long-term wealth accumulation through compound returns. It chooses the tortoise-like route to true riches over hasty wins. Before deciding on an investment strategy, investors should consider their risk tolerance using the following advice. Take a test to determine your risk appetite. Many brokers and financial websites provide questionnaires. They evaluate your capacity for handling uncertainty and setbacks. Examine how you emotionally reacted to previous market dips as you analyze your prior behavior. Are you afraid? Or were you able to maintain your composure and balance? Your genuine risk tolerance is shown by this. Think about your time horizon. Investors with longer time horizons are more willing to take on risk since they have more time to make up for losses. More immediate time frames call for cautious approaches. Determine whether you can tolerate losing 10%, 20%, or more of your capital. Before selling, consider how much risk you can take. Examine your income requirements. Volatile assets may not be appropriate for you if you depend on your investments for regular income. Appropriately diversify by combining low and moderate risk assets to create a portfolio that is in line with your risk tolerance. Don't take too many risks. Speak with a financial expert. A financial advisor may look over your entire financial situation and assist in determining the right degree of risk. Being truthful about your capacity to handle setbacks and instability is crucial. Don't let greed cause you to take unnecessary risks that you'll come to regret during market downturns. These risk tolerance tests are suggested by reliable sources. Vanguard Quiz. The 12-question test from Vanguard asks about time horizon, objectives, responses to volatility, and loss tolerance. Results in a score for the risk tolerance level. Fidelity Quiz. This 10-question test from Fidelity Investments gauges risk-taking propensities on a scale from cautious to aggressive. Charles Schwab Quiz. A fast 5-question test that yields a risk tolerance rating and investment advice. CNN Money Questionnaire. CNN provides a straightforward 9-question questionnaire to determine your level of risk tolerance and recommend suitable investments. Betterment Quiz. Online marketplace for investments. Betterment offers a brief risk assessment test with examples. Results in a conservative, a moderate, or an aggressive outcome. Bankrate Quiz. The 10-question quiz from Bankrate assesses your risk tolerance and offers asset allocation recommendations. Results can be printed. Merrill Edge Quiz. The Merrill Edge Quiz from Bank of America assigns you a risk personality and suggests portfolios for you. FINRA Assessment. The Securities Helpline for Seniors of FINRA offers a quick 5-question assessment on the danger of retirement investing. You can cross-validate and determine your ideal asset allocation based on risk appetite by taking 2 or 3 of these quizzes. The entire questionnaire can be reviewed for more information. Examples of low to moderate risk investments to take into account for a diversified portfolio in accordance with a conservative or moderate risk tolerance are given below. Low risk investments. Money market funds, extremely low risk investments in cash that offer greater returns than savings. Certificates of deposit, which are FDIC insured, give fixed rates of return. Short-term bonds, these are corporate and governmental bonds with maturities of 1 to 3 years. High-yield savings, FDIC protected savings accounts with greater interest rates. Bonds with high credit ratings from corporations and municipalities are known as investment-grade bonds. Dividend stocks, stocks of established businesses that consistently pay out dividends. Assets at moderate risk. Intermediate bonds, corporate and governmental bonds with maturities of 3 to 10 years. Blue chip stocks, these are the shares of well-known large-cap firms. Balanced funds, a portfolio of blended funds that includes both stocks and bonds. Real estate investment trusts, REITs, can offer income and moderate growth. Precious metals, as part of a well-balanced portfolio, gold and silver can act as volatility hedges. Index funds, diversification is offered by broad market index funds. To fit with your risk tolerance, the objective is to maintain a balance between lower risk assets like bonds and dividend stocks and moderate risk assets like blue chip stocks and index funds. Rebalancing needs to happen frequently. Here are some recommendations for selecting a trustworthy financial advisor to assist in identifying your risk tolerance and investing approach. Seek out recommendations from people you can trust, friends, coworkers, CPAs, etc. who have worked with advisors successfully. Verify credentials. Seek out experts with credentials such as Certified Financial Planner, CFP, Chartered Financial Analyst, CFA, or other areas of specialization. Look for fee-only advisors. By charging hourly fees or a proportion of the assets they are managing rather than commissions, fee-only advisors minimize conflicts of interest. Interview several advisors, set up initial meetings and inquire about their experience, credentials, clients, and services. Ensure that you are at ease. Look for fiduciary duty. Advisors who have this obligation are required by law to act in your best interests. Non-fiduciaries could suggest inappropriate products to earn commissions. Examine registrations. Check an advisor's registrations, disclosures, and complaints, if any, using FINRA's broker check or the SEC's IAPD. Be aware of the cost structure and choose fee-based rates over commissions. Fees ought to be explained in detail. Verify professional affiliations. Many credible advisors are participants in the XI Planning Network or the National Association of Personal Financial Advisors, NAPFA. If you look hard enough, you can locate a knowledgeable, reliable advisor who can advise you on determining your risk tolerance and financial objectives.